Joining us to discuss is Craig Johnson, the Chief Market Technician at Piper Sandler, and Matt Orton is the Chief Market Strategist at Raymon James. Welcome to you both. And Craig, I think you've said, lean into the rotation, financials, industrials, the broadening out. Is that right?
Absolutely, Kelly. That's exactly what we're seeing in this market. And it's been an interesting message as I've been conveying this to investors over the last couple of days. This is a bull market, but it's a rotational bull market at this point in time. We have been seeing stocks like you just were mentioning, Oracle, NVIDIA, Broadcom, all these stocks look like they're still due for some profit taking at this point in time. And it's, honestly leading to a lot of bit of frustration among investors. And then you start looking at energy, which we just did upgrade here in our publication this week. And we also start to see some strength in healthcare too. Things that haven't worked in a long time, Kelly, are starting to poke their head up. These cyclicals look good. And it looks like it's going to be an interesting play into 2026.
Matt, it's interesting that the way that the chart's set up is maybe aligning in some ways with some of the fundamentals that are also part of the market narrative right now, specifically around things like valuations, about this broadening out kind of trade happening. Even the small caps are now participating in that catch-up trade. Are we in the early stages of this right now, or is this just a blip on the radar like we've seen in the past that fizzles out in a few weeks?
It's a great question. It's one that most of our clients are asking us right now. How sustainable is this rotation? And I think it is sustainable in some key areas, because when you look at what's driving, I would argue a lot of this movement into small caps and say the energy complex, it comes down to economic fundamentals. And the economy has been much more resilient than expected. The Fed on Wednesday reaffirmed the fact that their economic outlook is more optimistic than it has been in the past. And in an environment where rates are coming down and have already come down meaningfully, that directly benefits small cap companies. So I'm quite optimistic on the outlook for small caps going forward. But I also think balance is really key for this year. While you're seeing some profit taking in tech, they are still the lion's share of earnings growth for this market. You still need to lean into the AI trade, but you can finally start to find success in areas, say healthcare, areas like energy. Even financials is a key overweight, I think, heading into next year, in regional banks in particular, which gets you down market cap.
I mean, I think overall the healthcare trade's been one that we've been trying to highlight as the catch-up, right? The small cap trade is the catch-up trade. The value sectors are in play right now. I think maybe the question I have about that, aside from the sustainability aspect of it, is if you are to find leadership in some of those value sectors, is it the ones that we've seen already so far? Is it going to be healthcare? It could be those industrials, financials, or is it going to be somewhere else that we want to lean in that market towards? I know that you're still long tech, right? I know that you still like names like Broadcom. I know that you still have NVIDIA as part of that kind of overall thesis. But just how much do you then alter the strategy? How do you rejigger the portfolio to take that view?
So I think you need to look at where you're going to put marginal dollars to work in this market. So I'm not leaving trades like Broadcom, like you mentioned. Today's a painful day, but the long-term thesis still very much remains intact. But as I think about putting some of those marginal dollars to work, I don't think there's significant credit concerns in this market. And as a result, I'm comfortable leaning into regional banks because we have seen strong earnings from most of those companies. And if rates are lower, net interest margins are improving. And as the market gets more comfortable where credit is, I think that's a key area that's sustainable with respect to expansion. Healthcare, for example, there's a lot going on in the healthcare space, and I think you need to think about healthcare with each specific vertical. While I don't want to own some of the HMOs, there's regulatory risk associated with it. There's a reason why those stocks are so cheap. Medical devices, I think, lean into the fact that we do have an aging population with more and more chronic diseases. We've seen a bottoming with respect to earnings growth in that part of the market. And I also think biotechnology also gets you further down market cap. But biotech has been working very well this year because there's increased M&A activity. You're finally starting to see a need from the big pharmaceutical companies to fill their drug pipelines that are starting to face very real patent cliffs over the next 3 to 5 years. So that's very sustainable, and that's what you want to lean into as an investor.